Welcome to this explainer. I am absolutely thrilled you're here today because, well, we're embarking on what I like to call a highly specific and absolutely critical financial rescue mission. Look, if you have a pension, I need you to lean in and listen very carefully. Almost everything you've read in standard retirement books, it's dead wrong. Seriously, the famous 4% rule, standard withdrawal sequences, typical tax advice, none of it was written for you. If you have a pension, the IRS literally treats you completely differently than every other retiree in America. They treat you differently than the person who just has a 401k, and they treat you differently than the person who's just scraping by on Social Security alone. And frankly, almost nobody out there, and I'm including a lot of professional accountants in this, really understands what that actually means for your tax bill. So today, we're going to completely shatter the pension tax illusion. To really understand why there is just so much bad advice out there, you only have to look at the numbers. Only 14% of private sector workers still have access to a real traditional pension today. Now compare that to the public sector where something like 86% of state and local government workers have one. So if you're watching this explainer and you have a pension coming your way, or maybe you're already collecting one, you are in a very small, very specific, and highly misunderstood group. You're practically a unicorn. The financial industry simply doesn't cater its mainstream advice to a 14% minority because, well, there's just not enough money in it for them to mass produce that advice. But today, we are throwing out that generic playbook and we're giving you the real numbers. Okay, let's dive into this. Here is our roadmap for today. We are going to cover number 1, the pension tax reality. Number 2, the Social Security trap. Number 3, RMDs and Roth conversions. Number 4, hidden Medicare surcharges charges. Number 5, the whole lump sum versus monthly debate. And finally, number 6, your new retirement framework. Let's get right into it. All right, trap number 1, the pension tax reality and why geography matters. So, the single biggest illusion out there is this idea that your pension income is going to be completely, or at least mostly tax-free, just because you already paid into the system during your working years. Let's burst that bubble right now. Okay. For the vast majority of employer-funded pensions, every single dollar you receive in retirement is fully taxable as ordinary income at your federal marginal tax rate. It is not taxed at those nice, favorable capital gains rates. Nope. It's taxed the exact same way your working wages were taxed. And here's where it gets wild. Geography matters for pension holders more than almost anyone else in the country. Individual states treat pension income incredibly differently. For example, if you happen to live in Pennsylvania, Illinois, or Mississippi, guess what? They don't tax pension income at all, 0%. States like Florida and Texas naturally have zero income tax across the board, so you're good there too. But then there's New York, where only the first $20,000 is exempt, and that's only if you're over 59 and a half. Everything above that, fully taxed. Or take California, where pension income is taxed at the state's regular rate, which can actually climb all the way up to 9.3%. Let's just put this into perspective for a second. Let's say you have a $40,000 a year pension. Living in California instead of Pennsylvania can cost you roughly an extra $3,700 a year. Over a 25-year retirement has a $90,000 difference. 90 grand for the exact same lifestyle, the exact same pension simply based on your zip code. That brings us to our next major issue, and I really want to ask you this directly. Did you know that your fixed pension is secretly pushing your Social Security into the 85% taxable zone? Most people have absolutely no idea this is happening. It's this hidden snowball effect that silently erodes the value of the Social Security benefits you worked your entire life to build. Let's break down exactly how the IRS pulls this off, which leads us to trap number 2, the Social Security trap and hitting those thresholds. Having a pension permanently changes the math on how your Social Security is taxed, especially when you compare it to your neighbor who maybe only has a 401k. The IRS uses a very specific and frankly a very unforgiving formula to figure this out. It's called provisional income. Now, provisional income is your adjusted gross income plus any tax-exempt interest you might have, plus exactly 50% of your Social Security benefits. This is it. This is the exact math the IRS uses to determine your tax paying. And here's the kicker that practically nobody warns you about. Your pension income counts fully toward this provisional income number. Every single dollar. There is no special exemption. There is no magic offset. It's all in there. Now, take a look at this. Get this. These tax thresholds were set way back in the 1980s and 1990s, and they have literally never been adjusted for inflation. Never. So, if you're married, filing jointly, and your provisional income crosses just $44,000, up to 85% of your Social Security becomes taxable. And because your fixed pension counts dollar for dollar before you even pull a single penny from an IRA, pension holders are mathematically guaranteed to be in this 85% penalty zone. Let's do a quick example. Let's say you have a modest $30,000 pension and a $24,000 Social Security benefit. Your provisional income instantly starts at $42,000. Think about that. You haven't even touched a single investment yet, and you are already facing massive taxes on your Social Security. A standard retiree without a pension can just dial down their IRA withdrawals to avoid crossing this line. But with a fixed pension, you can't just turn off the income tab. You are trapped. Moving right along, let's look at trap number 3, RMDs and Roth conversions, specifically the missing gap. Now, what's really interesting about this slide is how it completely flips traditional advice. A lot of standard retirement gurus will tell you that Roth conversions are all about finding a low tax bracket early in retirement. But as a pension holder, your strategy relies on this concept of the gap year. See, for most typical retirees, the absolute optimal time to do Roth conversions, moving money from a pre-tax IRA to a tax-free Roth IRA, is during those low-income gap years, right between when they retire and when they turn 73. But as a pension holder, you don't get any low-income gap years. The second you retire, your pension starts, and your income floor is permanently elevated. You are basically locked into a high effective marginal tax rate forever. So you might be wondering, why do a Roth conversion at all then? Well, because it is literally your only defense against a forced withdrawal nightmare. Later down the line, you really have to see the massive snowball effect of required minimum distributions, or RMDs. When you hit age 73, the IRS forces you to withdraw a certain percentage of your traditional IRA every single year. You don't get a choice. And those forced withdrawals, they stack right on top of your fixed pension and your Social Security. Let's say you have a fairly modest $400,000 IRA. At age 73, you're forced to take out about $15,000. By age 80, that forced amount jumps to $25,000. And by age 90, it's over 12% of the total account value. Suddenly, out of nowhere, you have $60,000 to $70,000 of fully taxable income shoved onto your tax return, whether you want it or need it. So, for pension holders, a Roth conversion isn't about finding a low bracket today. It's about paying a known tax rate right now so you can drain that IRA before RMDs create an impossible massive tax bomb when you're in your 80s. All right, let's turn to trap number 4, hidden Medicare surcharges, or as it's better known, the IRMAA cliff. When you start making proactive tax moves like those Roth conversions we literally just talked about, you have to watch out for this hidden cliff that catches thousands of retirees completely off guard every year. It's called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. It's a mouthful, but it's basically a sneaky Medicare surcharge that kicks in the second your income crosses very specific IRS tiers. If you're a married couple filing jointly and your income crosses the threshold, let's say right around $218,000, your standard Medicare Part B premiums don't just creep up a little bit. Oh no, a standard $22.90 monthly premium can suddenly spike to over $600 per month per person. And because your pension provides a permanently high fixed income floor to begin with, a totally standardized Roth conversion can easily and accidentally push you right over that IRMAA cliff. And here is what makes IRMAA so incredibly dangerous. The 2-year look-back rule. This is how they get you. Let's say it's 2026 and you execute a really smart $40,000 Roth conversion to reduce your future RMDs. Great job. Well, the IRS reviews that tax return in 2027. Then suddenly in 2028, your Medicare premiums spike by thousands of dollars. The IRS actually uses your income from 2 full years prior to set your current Medicare premiums. As a pension holder, every single financial decision you make must be evaluated with one eye glued to your federal tax bracket and the other eye firmly fixed on those Medicare IRA. It's this dual threat calculation that, frankly, most standard off-the-shelf tax software won't even warn you about until it's too late. That brings us to trap number 5, lump sum versus monthly payouts, and the massive tax flexibility debate. This revolves around what is probably the single biggest, totally irreversible decision you will ever make as a pension holder. Do you take the lump sum or do you take the monthly payout? Now, most financial talking heads treat this strictly as a math problem. They'll ask you, hey, can you invest the lump sum and beat the monthly payment return? But honestly, that completely misses the point. This is really a debate about tax flexibility. Think about it. If you choose the monthly payment, you get amazing peace of mind, guaranteed income for life, zero investment risk. Sounds great, right? but you have absolutely zero tax flexibility. That money hits your tax return every single year, fully taxable, and you cannot stop it. Now, if you choose the lump sum and roll it into an IRA, you suddenly have total control. You get to decide exactly when to take income. You can actively manage your provisional income for Social Security. You can control your IMA exposure. But on the flip side, you take on all the investment and longevity risk. You see, the lump sum is only the better option if you are going to actively and aggressively manage the tax timing of every single dollar for the rest of your life. But there is a secret third door here, the hybrid option. Some pension plans actually allow you to take a partial monthly payment alongside a partial lump sum. This is an incredibly powerful middle ground. It's like the best of both worlds. You can take just enough monthly guaranteed income to safely cover your basic fixed expenses. We're talking your housing, food, and utilities, and then take the remainder as a lump sum so you retain that vital tax control and flexibility over your discretionary spending. A shockingly high number of retirees don't even know this exists. You absolutely must ask your pension administrator if a partial lump sum is an option for you. It's a total game changer. Okay, we are on to Section 6. Your new retirement framework and asset liability matching. Okay, we've outlined all the traps. Now it's time for the solution. If that standard 4% withdrawal rule doesn't apply to you, what actually does? Well, you must match your fixed needs, the absolute essentials you have to pay for just to survive, like your housing, food, utilities, and basic insurance directly to your guaranteed income, which is your pension and your Social Security. So, the crucial point is if your pension and Social Security cover those core expenses, it changes the entire geometry of your wealth. It means your 401k or your IRA is no longer required for your daily survival. You can use that money exclusively for your wants. You know, world travel, a new car, spoiling the grandkids, or leaving a legacy. Your pension is doing all the heavy lifting. It is your massive safety net. And that entirely transforms your investment portfolio from a stressful survival fund into a pure, exciting opportunity fund. And this brilliantly illustrates how that shift changes your entire investing strategy. A reimagined portfolio for a pension holder looks totally different from the norm. A typical retiree is always told to hold a super conservative 60-40 or even a 50-50 mix of stocks and bonds just to protect their income. But as a pension holder, your pension is essentially acting as a giant unbreakable bond allocation. Let's walk through an example. Let's say we have a 66-year-old couple. Their fixed expenses are $68,000 a year, but their combined pension and Social Security guarantees them $76,000 a year. That means they have an $8,000 surplus before they even touch their $450,000 401k. Because their daily survival is completely secured, they don't need their 401k to be stuffed with low-yielding conservative bonds. They can actually afford to be far more aggressive, like an 80% stock and 20% bond split. If the stock market drops 30% tomorrow, they don't lose their house. They just delay a vacation to Europe. Pension holders have this unique superpower to invest for aggressive growth simply because their baseline is totally secure. But while we're talking about securing that baseline, I have to give you a serious warning here about a devastating spousal trap regarding exactly how you elect that pension. When you retire, you usually have to choose between a single life payout, which maximizes the monthly check while you are both alive, or a joint and survivor payout, which pays a little bit less each month, but guarantees income for your surviving spouse. Way too many people take the higher single life payout just because it looks so much better on paper today. But here's the tragic reality. When one spouse passes away, the household expenses only drop by about 25%. Think about it. The mortgage, the utilities, the property taxes, they all stay mostly the exact same. But if you chose the single life option, your household income might plummet by more than 50% because a Social Security check vanishes and the entire pension vanishes right along with it. Always model the survivor gap. The joint and survivor option is essential insurance for the most vulnerable years of your spouse's life. And there's one more undeniable reason you absolutely need that investment portfolio to be aggressive. Inflation. It is the silent killer of the fixed pension. Most pensions today do not have a cost of living adjustment or COLA. So if you lock in a $36,000 pension today, you get exactly $36,000 in year 10 and exactly $36,000 in year 20. But with a historical average of just 3% inflation, look at what happens to your actual purchasing power over time. By year 10, that check only feels like $27,000. By year 20, that $36,000 pension only buys what $20,000 buys today. It's an invisible erosion of your wealth. And this is exactly why you need that aggressive 401k portfolio we just talked about. It's not just for fun. It is literally mandatory for late-stage retirement survival because it acts as your primary inflation defense, bridging that massive gap when your fixed pension no longer covers your rising expenses. Which leaves us with one final critical question for you to ponder. Will you let the IRS silently drain your pension, or will you take control of your financial future today? Look, if you have a pension, the absolute most expensive mistake you can make is doing nothing and just assuming it will all sort itself out. Trust me. The IRS is never going to send you a friendly letter telling you that you're overpaying your taxes. So here is your action plan. Find out your actual lump sum and partial lump sum options from your administrator. And most importantly, sit down with a fee-only financial planner, not a salesperson trying to sell you an annuity, but a true planner who actually understands this highly specific pension taxation math. Have them model your next 20 years, not just your next 2. You have a massive financial advantage with a pension, but only if you navigate these traps properly. Thank you so much for joining me on this deep dive in this explainer. Take control of your strategy, protect your hard-earned wealth, and I'll see you next time.